coming to you on, excuse me, Tuesday morning, July 31st. On last Wednesday, Facebook closed at a record high, only to nosedive below its 200-day moving average after reporting. Was there any indication of Facebook's faceplant? Is Tesla, which reports August 1st, predicting bad earnings? One could argue that Tesla is predicting bad earnings. Maybe it's semantics, but rather than say price action predicted something, a more accurate description would be to say that traders are anticipating a particular outcome. As legendary trader Bernard Baruch said, successful speculation is about anticipating the anticipators. When a stock trades down into earnings, a gap down often indicates that market participants quickly cover within the first few hours or 3 days. In other words, if a stock is already trending down and then gaps down after earnings, typically market participants will cover quickly within the first few hours to first 3 days. However, when a stock is in a strong position going into earnings, such as Facebook, and then disappoints, the gap down can be an abyss that breaks the back of the stock for some time to come. Such was the case with Facebook. It closed at record highs on Wednesday before sandbagging or reporting. Was there any indication other than Facebook being vertical that it was vulnerable? W.D. Gans stated that time is more important than price in determining trend. He also stated that as below, so above. Checking a weekly Facebook, let's get a weekly up here. Okay, checking a weekly FB shows that from its initial breakout, let's get back there. Right here, back in 2013, that reclaimed its post-IPO highs, Facebook carved out a 13-week vertical advance. Now let's go back to present time. This is a weekly chart, and here is a 13. Oh, this is not the weekly. And here you can see, after it recaptured its 50-day moving average, Facebook carved out a 13-week advance into the closing weekly high the week before reporting. So as above, so below. The advance into the closing weekly high on the week of July 16th was also a vertical 13-week affair. So there's that. Also, this year's January to March decline in Facebook, right here, overbalanced all prior declines on the way up at the last 5 years advance. That was a warning that a new high was likely unsustainable and probably a squeeze play. As I always say, the first mouse gets the cheese. The first sell signal sees short squeezed, while the second mouse gets the cheese. In other words, the second sell signal gets the cheese for the bears, while the first sell signal often sees players squeezed. FB left an outside down reversal month. Go back to the monthlies. FB left an outside down reversal month in February, right here where this green arrow is. That was a big mouse. July is the second down, outside down month. It may be the second mouth. It certainly looks unequivocal. FB hasn't traced out 2 consecutive lower monthly lows in its history. You see 2 consecutive lower monthly lows here. Here, maybe 2 consecutive lower monthly lows. and here. August begins this week. Facebook is likely to see trade lower than July's lows in August, and it will be important to gauge its behavior at that juncture. FB was magnetized to the open gap from April 26th like a heat-seeking missile on the third day following the gap. Let's take a look at that. So yesterday, on the third day following this massive gap down, Facebook was magnetized into the open gap right here from late April. It would not be surprising to see a snapback to 50% of the year's range, which ties to 183, 184, right back in here, on a Pinocchio of the 200-day moving average, this magenta line. Be that as it may, Facebook is likely destined to trade below whatever July's lows are in August. Consequently, a rally that plays out to around this 50% range, 50% retrace of the year's range, around 183, 184, prior to trade below July's low, sets up a nice short side opportunity. When FB nosedived below the prior high from January at 195, let's go back here and take a look. Okay, so here you can see the late January high at 195. When Facebook knifed below that high on earnings, it opened up after reporting above 200. But when it knifed back below that 195 level, the prior January high, it was all over but the shouting. It opened above 200, as I said, after reporting, but when prior resistance, that 195 level, failed to be new support, FB collapsed. The first loss was the best loss. I can't help but wonder how many players were closed out of the rally on the way up prior to earnings, hoping for a pullback to buy. When it came, it was precisely the wrong thing to do, to buy. I also can't help but wonder how many shorts covered on the first blush down because they've been so singed in the past with stocks bunging back in their face. This is just the way Mr. Market rolls. On July 26th, we posted an article on the T3 Live blog, Tesla in La La Land, technically speaking. So now let's look at Tesla as it reports on August 1st and see what the expectations may be going into earnings. Unlike Facebook, that was at record highs before reporting, Tesla is in a weak position. We sent an alert on July 26th, the day we posted the Tesla in La La Land article, to short Tesla at the market. Why? It had turned its 3-day chart up. Let's try to zero in on that. The 3-day chart turns down here on 3 consecutive, well, it's pointing down, it turns down here, turns up, turns back down, never turns its 3-day chart back up with 3 consecutive higher daily highs. But we were stalking it after this gap down below support, hoping for a turn up in the 3-day chart, and it came. We were waiting for a turn up in this 3-day chart to define a high. When a stock is in a strong downtrend, a turn up in the 3-day chart often defines a high. When strongly downtrending stocks try to stand on their tiptoes, they set up shorts. When strongly uptrending stocks crouch, for example, when they turn their 3-day chart down, it often sets up buys. In league with Tesla backtesting its 3-day chart. I'm sorry, in league with Tesla turning up its 3-day chart, it backtested a broken trend line last week. That's a trend line connecting these lows with these lows, and it comes in right here. Additionally, if last week was putting in another lower pivot high, it would install a third lower high from the June high. So here's the June high, here's a first lower high, a second lower high, and this may in fact be a third lower high in front of earnings. And this is important to know because waterfall declines often follow third lower highs. Yesterday, we sent an intraday note out to cover half the Tesla short for a near 17-point gainer. The takeaway is this: the market has many moving pieces. In my experience, the more you try to see, the less you see. I try to keep it simple with a few proven tools which I have developed over a 30-year trading career. These tools do a good job of identifying the primary and secondary trend. First and foremost, this is what is required of a trader, because if you can't determine the trend, if you can't measure risk, you can't manage risk. So Tesla is in a weak position, unlike Facebook, and if it gaps down, it may test the lows of the year and find traders covering rather than extending. We'll see what happens. That's it for today. Good luck trading this afternoon, and thanks for listening.